Welcome to the 3 Edge Week in Review for the week of September 11th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. This week, Steve and I will once again be discussing inflation and how, although many on Wall Street have seemed convinced for some time now that inflation is well on its way down to the Fed's 2% target, there are more than a few reasons why it may end up stuck above the 2% target, and we'll examine what that could mean for the markets. Before we get to that, a brief recap of the most recent activities in the markets. And thus far in mid-September, after a down month for the S&P in August, month to date here in mid-September, the S&P is still slightly negative. And speaking of inflation, this past week, the Bureau of Labor Statistics issued its report on inflation for the month of August. And the CPI showed an increase in headline inflation, partially driven by the surge in oil prices, which recently hit $90 a barrel, which is the highest level since November of 2022. In addition, core CPI, which excludes food and energy, was also higher in August, and it was higher in August than it was in July, and so that marks the first month-over-month increase in core CPI since February of this year. So all in all, the inflation report was mixed. It wasn't terrible. It wasn't great. But I do think there's enough in the report to throw a little bit of cold water on the idea that the Fed can be confident that it's done raising short-term interest rates. And although they probably won't raise rates at the September FOMC meeting, which actually is next week, they may need to keep rates higher for longer in their ongoing battle against inflation. So Steve, let me bring you in here. Let's revisit the topic of inflation. I mean, it's really important for consumers and investors alike, and particularly now that we've seen this dramatic increase in the price of crude oil. So what is your outlook now? Can the Fed get down to this 2% target? Is that likely? What do you see in terms of the lay of the land, if you will, for the future path of inflation?
Well, Fritz, you're asking about an inflation forecast, and I have to say that research has shown definitively that economists, Wall Street analysts, the futures market, even the Fed, the Federal Reserve Board itself, has had a very poor track record forecasting inflation. And so when we've heard economists after economists or analysts after analysts predicting that inflation is going to come down to 2% and stay there, and that's even built into some of the futures markets, consider me naturally skeptical that when I hear a parade of overly optimistic inflation forecasts like that. And I do think that a lot of these forecasts suffer from recency bias, meaning that the easiest thing to do is to see that inflation went from 9% to 3%, and you extrapolate that trend and say, well, we're very right on the verge of 2%. And that it'll stay there and we'll be back to normal. So here, I think that one should be very skeptical of that forecast and be cautious in that inflation perhaps now is starting to tick up again. We did go from 9% to 3%. Since then, we've ticked up to 3.2%, 3.3%, 3.7% in the latest round. And it wasn't just random noise. It coincided with the rebound in crude oil prices. And if you remember, crude oil prices were, I think, over $120 a barrel not so long ago, fell all the way down to below $70, a huge fall. And that's had a big role in inflation coming down quickly from the 9%. And now we're back up well over $90 a barrel and looks like it could climb higher. So even though it's one component, there's been a surprisingly strong correlation between inflationary expectations and oil prices. And this chart shows that over time, over different cycles when inflation and oil prices have gone up together, when they've come down together. And so when oil prices rise from $70 a barrel to over $90, as they have done recently, we expect inflationary expectations to start to move higher. And that hasn't happened yet in the markets, but we think the markets will eventually catch up with that. So I think there's not only a direct impact on the inflation statistics because crude oil is part of that, but there's an indirect component. There's the psychology of people going to the pump and seeing their gasoline prices go up. There's a lot of indirect input and inflation from crude oil prices going up and transportation, which adds to cost of many different goods and even some services. So I think it's way too early to call victory on inflation, and that we could actually be going a bit higher, not lower.
All right. So let's maybe dig a little deeper there. And so we have the price of crude, very high correlation to inflation. What are the other factors that could make the Fed's job, if you will, more difficult in terms of getting inflation down to their 2% target? What else is going on, I guess, is my question.
So, as you brought up, energy is a big part of the inflation statistic. And not only crude oil and gasoline, but the transition into clean energy. That is going to be expensive. And that's going to drive inflation. Next component you may think of is food. Food prices spiked when the Ukraine invasion started. And then they fell back when things sorted out. But it's easy to see sometime in the future another spike in food prices, either because of geopolitical tensions or because weather is so volatile. Another factor, the cost of borrowing, that's an input cost. And that's gone up a lot in the last several months with interest rates rising. And governments are going to have to pay a lot more to borrow money. Corporations, real estate developers, etc. Another cost has to do with demographics. We see the big baby boom generation. More and more people are retiring, and that's reducing the size of the labor force. And demographically, we're not rebuilding the supply in the labor force to offset that. And so we're seeing that there's been a surprising labor shortage. Now, some of that is looking like it's working off a bit lately, but still there's been a lot more activism with labor unions, and there have been some settlements that have resulted in big wage hikes. And if wages go up and continue to go up quite sharply, that will factor into higher inflation. And then finally, over the years, there's been a big so-called peace dividend, because after the Cold War, the amount of money that governments spend on defense as percent of GDP has been falling pretty dramatically over time. And only now is it starting to turn around and rise. And there seems to be no shortage of tension in the geopolitical realm. And we see defense spending rising, and that's expensive. So we think there are many components that could keep inflation elevated.
That's a pretty robust list. So thank you for that. One interesting thing that reminds me of is this idea that, well, people don't always feel the bite of inflation. For example, if you're a borrower, if you have a mortgage, you don't feel that bite until, oh, well, next year I have to roll over that mortgage, and all of a sudden you're at, obviously much higher costs there. But that's a pretty robust list. So thank you for that. So we know that, and as you said very astutely at the beginning, the course of inflation, like most things in the economy and the markets, is highly uncertain. But my final question is based on what we've discussed here today and the points that you've made. Is there something investors should consider doing in terms of their portfolios at this point?
Well, I have to say that there are a growing number of Wall Street analysts that are saying now is the time to jump in and buy long-term bonds, that inflation's coming down, interest rates are going to come down, and now's a good time to get in. Of course, they said that last year and it didn't work, and they said that the year before and it didn't work. And we're still skeptical, as we've been talking about, that we are not as confident that inflation is going to come right down to 2% and stay there for all the reasons we mentioned. So when it comes to fixed income, we still favor short-term treasuries, and that way we can avoid the duration risk of longer-term bonds. If interest rates go up, the principal value of bonds declines, and you lose money. We think it's not worth the risk. And so for people allocating their money in a diversified portfolio, we say for your longer term or intermediate term bonds, be at your minimum part of your range, not at your maximum part of your range. So we favor short-term treasuries. And we also would favor an allocation to TIPS, Treasury Inflation Protected Securities. Right now, you can buy a Treasury Inflation Protected Security and be guaranteed by the U.S. government 2% over and above the CPI, the Consumer Price Inflation Rate. That's a good deal.
Yeah.
And if inflation does continue to go up, unlike bonds that lose principal value, your TIPS will do well. In terms of corporate credit, we still think that credit spreads are too narrow to account for the possible risk of a recession. We know a lot of analysts are saying the threat of recession is completely gone, no worries. Again, we're skeptical about that. We think there still could be a big delay, and we could see the effect of all of the Fed tightening happen sometime in the future, not that it's already passed. In terms of real assets, if the Fed continues to pause and not raise rates in anticipation of higher inflation, and inflation continues to rise, then it'll be a situation much like the 1970s. You can see this accompanying chart that shows how in the 1970s, they also declared victory on inflation prematurely. And then after falling, after the first peak, it rose again to a new peak. And if the Fed acts like it did in the 1970s, then we could see inflation tick up again. And if they don't follow it, then real interest rates will go down. And that would be fantastic for gold. So we do advocate having some gold in your portfolio. We do like commodities longer term because for a long time, commodity producers have been withholding their supply. But we favor commodities after the threat of a recession is passed. We don't think it's passed yet. And then back to equities. We think It's really important, not as a day trader, but as a longer term investor, to really consider when you go into equities, are you just riding a trend? Or are you thinking about your reward to risk ratio? How much reward do you expect to get from investing equities at this point in time versus what risk you're taking on? And as short-term traders drive the equity markets more and more deeply into overvalued territory, what our models show is that the reward to a longer-term investor is actually declining because you're buying at a more expensive price. And the risk to a longer-term investor is actually increasing because you're more deeply overvalued. And if you correct back to fair value, that could be a substantial loss. So we still are very defensive when it comes to investing in overvalued equities like U.S. equities, particularly the S&P 500. So we're at our minimum allocation there. But we are on the lookout for other equity indices that might have a better reward to risk ratio. Several months ago, we identified Japan, and that was a surprise for a lot of people, but Japan is undervalued as opposed to overvalued. And Japan has done very nicely this year, in absolute terms and in relative terms. And we'll be on the lookout for other equity indices that might fit that profile as well.
Great. Thanks. I love that chart. Okay, good. Thank you, Steve. Very good. Thanks for all your insights on inflation. And actually, the one thing that jumps out at me when we talk about all this and the current environment is the parallels between the 1970s oil embargo, speaking of oil, and today's alliance among the OPEC plus members and Russia and Saudi Arabia's recent announcement that they're going to continue to limit oil production at least through the end of the year. And, as we know, OPEC plus includes Russia, Saudi Arabia, and Iran, among others. And that is not exactly a list of our strongest strategic partners, to say the least. And if you remember back to the 1970s, right, we had the oil crisis, and that was really brought on by the oil embargo against the U.S. by a cartel of oil-producing countries. So I just find that whole situation to be concerning. And one short-term remedy would be for the U.S. to release oil from the Strategic Petroleum Reserve. But unfortunately, if you look at this chart, we see that, they already did that in order to combat inflation. The Biden administration drew down the Strategic Petroleum Reserve. And so that is not something that's available to us at this point, which makes this whole situation with OPEC plus even, a bit more troubling.
Very good point, Fritz.
And whatever happens, you and I will continue to follow it and report out on the situation in future videos. So that will do it for Steve and me for this week. We'll be back next week with another edition of the 3 Edge Weekend Review. All our videos are available on our YouTube channel. And if you think someone you know might benefit from our weekly videos, please feel free to share them. You can simply send them the link to our YouTube videos. So until next time, on behalf of Steve and everyone here at 3 Edge, we wish you all the best and thanks for listening.